Imagine you're just standing in the grocery aisle. You grab a simple bag of potato chips, maybe a carton of milk, and you scan them at the register.
Right, just a normal Tuesday.
Exactly. It feels like the most basic, straightforward transaction in the world. You
Yeah.
pay your money, you eat your snack. But what if I told you that single mundane purchase is directly tied to a 400 million peso lost at sea mystery?
Oh, wow.
Or like an intricate accounting ledger that literally tracks the daily genetic merit of exactly 33,371 living, breathing pigs.
It is a totally jarring contrast, honestly. We tend to view consumerism through a very, very narrow lens.
Yeah.
We just see the brightly colored packaging on the shelf, right?
Yeah.
And we see what's in our pantry. We completely miss this sprawling, incredibly volatile financial ecosystem that's operating just beneath the surface to make that simple transaction possible.
Well, welcome to this custom deep dive. Today, we are tearing down that narrow lens just for you, our listener. We're going straight to the source material to uncover the hidden financial reality of a massive Asian food and beverage empire, which is Universal Robina Corporation, or URC.
And specifically, we are examining their audited 2025 financial statements. And, these were prepared and thoroughly vetted by the independent auditor, SGV & Co.
Right.
So this isn't some casual press release designed for marketing. This is the definitive 50-plus page legal record of their actual financial reality.
And our mission today is to basically decode that record. We're looking for the story hidden inside all those spreadsheets because a corporate financial statement of this magnitude is just packed with drama.
It really is.
It's a tale of massive growth, brutal logistical nightmares, and some incredibly clever corporate maneuvering. So, okay, let's unpack this. Before we get into the farms and the factories, we really have to look at the sheer scale of the money flowing in and out of the business in 2025 compared to 2024.
Yeah, the big picture.
Exactly. And on the surface, the numbers look like a massive cause for celebration. I mean, URC's total sales of goods and services actually grew. It jumped from 130.1 billion pesos in 2024 up to an impressive 134.8 billion pesos in 2025.
Which, by almost any traditional consumer metric, selling nearly an extra 5 billion pesos worth of products is a phenomenal achievement.
Yeah.
It tells you their market penetration is strong and, consumer demand for their brands is clearly growing across the region.
But here's where the narrative takes a really sharp turn. Despite that massive surge in revenue, their net income plummeted.
Completely dropped.
Yeah, it dropped from 11.1 billion pesos in 2024 down to 8.86 billion pesos in 2025. And their earnings per share, which is basically how much of that profit is allocated to every single share of the company's stock, dropped from 5.14 pesos to 4.14 pesos.
It's a tough pill to swallow for investors, for sure.
It's like throwing a massive sold-out music festival, right? Ticket sales are absolutely through the roof. You've got thousands more people there than ever before. But because you spent exponentially more on stage lighting, private security, and catering for the bands, you actually take home significantly less money than you did at last year's much smaller gig.
That's a perfect way to look at it. And what's fascinating here is how clearly this shatters that illusion that higher sales automatically equal higher profits.
Right.
Top-line revenue is essentially meaningless if the cost to generate those sales is accelerating faster than the revenue itself. I mean, when you dive into the auditor's notes, the culprits dragging down that net income become glaringly obvious.
The expenses just ballooned.
Exactly. First, you have the cost of sales. It cost URC a staggering 105.4 billion pesos just to physically produce the goods that generated that 134.8 billion in revenue.
Wait, let me visualize that. So out of every 100 pesos they make at the register, almost 80 pesos is instantly swallowed up just paying for the raw ingredients, the factory power, and the packaging.
Yeah, 80% right out the door.
That leaves a razor-thin margin to cover literally everything else.
It is a brutally thin margin.
Yeah.
And that everything else is also getting way more expensive. Their selling and distribution costs, so the actual act of marketing the products and physically trucking them onto store shelves, that climbed to 15.8 billion pesos. But the real shock to the system in 2025 was a massive jump in something called impairment losses. They recorded 708.5 million pesos in impairment losses for the year, which is a massive leap compared to just that 160 million they recorded the year before.
Okay, I need to pause you right there because impairment loss sounds like a term an accountant uses to make bad news sound incredibly boring.
It does sound a bit dry, yeah.
What exactly is an impairment loss in plain English? Like, are we talking about a factory literally burning down, or is this some kind of invisible paper loss?
Well, it can be physical, like, say, equipment breaking beyond repair, but at this scale, it's usually a paper loss that reflects a harsh economic reality.
Okay, how so?
An impairment loss happens when a company realizes that an asset they own, let's say a specific piece of specialized manufacturing equipment or even a brand trademark, is simply no longer worth what the accounting books say it's worth.
Oh, I see.
Yeah, so if the market demand for a certain snack crashes, the machine that makes that snack suddenly isn't going to generate the cash you expected. So the auditor requires you to write down the value of that machine on the balance sheet to reflect reality.
So you have to admit it's worth less.
Exactly, and that write-down hits your profit statement as a loss, even if no actual cash left your bank account that day.
That makes total sense.
Yeah.
So they are selling billions of pesos more in snacks and drinks.
Hmm.
But the raw cost of the ingredients, the sheer expense of trucking it all over the ASEAN region, and the sudden realization that some of their assets are losing value have completely eaten up the profits from those extra sales.
That's the painful reality of it.
Which makes me wonder, honestly, if the raw materials are such a massive drag on the bottom line, how do they manage the origin of those materials?
That is the perfect question to ask, and it takes us straight from the corporate boardroom to the mud of the actual farms.
Okay, the farms. Let's go.
To manage those raw material costs, URC operates a highly complex agricultural division. In fact, in 2025, they changed their operating structure to highlight a newly carved-out segment called Animal Nutrition and Health, or ANH.
And the A&H segment focuses on animal feeds, pet food, and veterinary drugs.
Oh.
And this shift brings us to a line item on their balance sheet called biological assets.
Yes.
Here's where it gets really interesting, you guys. In 2025, these biological assets were valued at 461.2 million pesos. That is a huge jump from 273.7 million the previous year.
It's massive growth.
And the notes to the financials don't just give a vague estimate. They track exact living headcounts. They're managing 33,371 swine and 506,831 poultry.
They literally count every single bird.
Yeah. They even categorize the pigs by their exact life stage. So you've got sucklings, weanlings, and fatteners or finishers. But I am genuinely stuck on the mechanics of this. How on earth does an accountant track the value of a pig as it literally grows?
It's a fair question.
You can't put a barcode on a weaning piglet that updates its price every time it eats a pound of feed. Isn't it slightly surreal that a living, breathing, growing animal is treated exactly like a piece of inventory on a balance sheet?
It sounds like a complete logistical nightmare, but international accounting standards have a very strict, honestly brilliant mechanism for it. It's called fair value accounting for living things.
Fair value accounting, okay.
Think about it. A pig isn't like a tractor. A tractor slowly loses value every day as it rusts. A pig is literally growing, it's gaining mass, and it's increasing in market value every single day.
Right, because it's getting closer to being sold as meat.
Exactly. If you only valued the pig at what it costs to breed it, your balance sheet would be entirely inaccurate. So they value these biological assets based on what the auditors call adjusted commercial farm gate prices.
Farm gate price.
Yeah, minus the estimated cost to sell them, like the commission a livestock broker would take.
So the value isn't static. It's almost like a stock ticker for livestock.
A very fleshy, noisy stock ticker.
Yeah.
The value fluctuates based on the animal's age, its specific breed, its genetic merit, which just means its potential for breeding or producing high-quality meat, and, of course, the daily market prices for pork or poultry. In 2025, URC actually recorded a 6.1 million peso gain on their income statement simply from changes in fair value.
Wait, hold on. Are you saying the company made 6.1 million pesos on paper simply because the animals got older, heavier, or the market price for meat ticked upward? No one actually bought those pigs yet.
That is the exact reality of agricultural finance. The biology directly dictates the math.
That's wild.
As a suckling pig transitions into a weanling and then a fattener, its fair value objectively increases. The financial statement is simply reflecting the biological reality of the farm in real time. It's this fascinating collision of nature and corporate accounting.
I want the listener to just visualize that for a second. An auditor from SGV & Co. essentially has to verify that the genetic merit of a herd of 30,000 pigs aligns with current farm gate prices.
It's a tough job.
It really is.
Yeah.
But while those biological assets are literally growing in value in a controlled farm environment, other assets are facing the sheer chaos of the outside world. Because eventually, Those products have to leave the farm or the factory and travel through a global supply chain.
And the global supply chain is arguably the most vulnerable point in any multinational operation. The moment a product goes onto a truck or a cargo ship, the company is exposed to an enormous amount of risk.
And the financial statements put a very precise, very painful number on that risk. In 2025, URC had to write off a staggering 385.4 million pesos for inventory classified as in transit.
Just gone.
Gone. We are talking about finished goods, raw materials, and packaging that management deemed completely unrecoverable.